Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's the weekend, so let's recap the action. The week started with the market trying to trade hope, but it ended with an ugly Friday flush that looked a lot more like forced de-risking than normal profit-taking. The driver all week was the same loop. Geopolitics kept oil bid. Oil kept inflation expectations hot, and that kept rate anxiety front and center. Now, heading into Monday, March 30th, the setup is primed for gaps because positioning already looks defensive. On the weekly time frame, the problem wasn't just that we closed red, it was how we closed. This week's tape finished heavy, with sellers defending every rally into the close. The S&P 500 ended around 6,368. The Nasdaq closed near 20,948, and the Russell 2000 finished around 2,449. Classic sell-the-bounce behavior in a macro-driven market. The technical posture into the weekend says buyers are hesitant, and until oil and yields cool off, rebounds may just keep getting sold. Building on that weekly chart picture, the money flow was very straightforward. Over the past week, investors rotated into energy and the defensive playbook, utilities, staples, healthcare, while cutting exposure to duration-heavy mega-cap growth and to small caps. The why was macro. Crude strength acted like a tax on growth, and it pushed inflation and rates back in control. And Friday just reinforced it. Oil strong, equities weak, which is the market's way of saying macro is running the show. Over the weekend, the key point is what hasn't happened. There's no single confirmed headline that resets the market's story, that keeps the setup fragile. The lingering tension from Friday is all about crude-driven inflation fear, and that feeds straight into rate expectations. On top of that, Powell speaks Monday morning, so the market's staring at headline-driven volatility right out of the gate. And in crypto, weekend chatter is mixed and noisy, more chatter than signal. But if crypto slides Sunday night, it can still amplify risk-off psychology into Monday's open. March is going out with a roar, but not the kind investors wanted. We just logged a fifth straight losing week, with the Nasdaq officially in correction territory. The main culprit? A deepening conflict in Iran that's put the Strait of Hormuz in a chokehold. Energy is the only sector in the green this month, up about 13% as oil prices act like a global tax on growth. And it's not just fuel prices, it's the uncertainty. The Fed feels backed into a corner, and with consumer sentiment hitting new lows for 2026, that soft landing story is starting to feel like a distant memory. This isn't just a dip anymore, it's a fundamental repricing of risk as we head into Q2. The AI crown is feeling heavy this week. Nvidia is facing its biggest political challenge yet, even with that massive $1 trillion order book they rolled out at GBTC earlier this month. The stock's reeling under the threat of a full export freeze. The Senate Banking Committee is now pushing for a complete pause on advanced AI chip sales into Southeast Asia, after revelations that over $500 million in servers were illegally diverted to China. For the first time, Wall Street is questioning whether Nvidia's compliance moat is as strong as its hardware. With growth benchmarks down about 3.4% this week, the so-called Magnificent Seven are looking vulnerable. Nvidia is fighting to hold the 167 level. If that breaks, the AI trade could be in for a very long spring. We also have to talk about the EV winter getting a lot colder for Tesla. Tesla shares dropped about 3.3% on Friday, after the company published a full-year 2026 delivery forecast that shocked even the bulls. A target of 1.69 million deliveries basically signals flat growth. The Juniper Model Y was supposed to reignite the story, but the data says otherwise, about a 13% sequential drop from the end of last year. From rising insurance costs to the loss of federal tax credits, the headwinds are piling up. Elon Musk is still betting big on Robotaxis and Optimus, but right now the market cares about the car business, and that business is staring at its toughest margins since 2019. Keep a close eye on that 380 support zone as we open next week. Starting our stock focus with Nvidia, this was the battleground of the past week. When rates rise and macro uncertainty spikes, the market goes after duration first, and Nvidia is the poster child for that risk on premium. Add export risk and policy headlines on top, and you've got a name that can gap hard in either direction. Heading into Monday's open, watch whether Nvidia can actually stabilize. If it can't, that's a warning the market still wants less growth exposure, not just different growth exposure. Exxon is the cleanest single-stock way to play what led this past week, energy. When crude stays bid, it works like a global tax on growth, and it keeps the Fed path feeling a lot less friendly. That's why energy leadership matters beyond the sector. It can cap the entire index. Into Monday, if Exxon keeps pushing, it reinforces the inflation risk regime. If it rolls over with crude, that's your first clue a relief rally might actually have room to breathe. Tesla mattered this past week because it's a high-volatility sentiment amplifier. In a tape that's already risk-off, Tesla weakness tends to spill into the broader speculative complex. Heading into Monday's open, it's less about debating the long-term vision and more about what the market's pricing right now: growth, margins, and demand. Keep an eye on that 380 zone as a key reference point. If it can't hold, it's another signal that risk budgets are still shrinking. SLV is on the list because it helps confirm the regime. This past week, the market leaned into defense and inflation hedges as equities sold off. If SLV keeps a bid into Monday and through the data gauntlet, it tells you investors are still willing to pay up for protection. If SLV fades while equities stabilize, that lines up with risk appetite slowly coming back, but you want to see that paired with cooler oil and calmer yields. GBTC is a watchlist name for one main reason: the Monday open. Over the weekend, crypto chatter is mixed and noisy, so treat it as chatter, not confirmed signal. But if Bitcoin moves sharply while equities are closed, GBTC can gap, and it can nudge broader risk sentiment right at the open. Just keep it in perspective, the primary driver is still macro, oil, yields, and the Fed narrative. Here's the week ahead, and it's a big one for rate expectations. Monday morning, Fed Chair Powell speaks, which is immediate headline risk for yields and for growth stocks. Tuesday brings jolts and consumer confidence. Wednesday is stacked with ADP, retail sales, and ISM manufacturing, especially watch ISM prices, given the oil backdrop. Thursday is jobless claims. And Friday is the main event: non-farm payrolls, the unemployment rate, and hourly earnings. Heading into Monday's open, the playbook is simple: manage risk, respect gaps, and watch whether oil and yields confirm or contradict the market's fear from this week's close. To wrap it up, this past week's close sent a clear defensive message. When macro gets louder, the market sells duration and sells liquidity. Over the weekend, the job is staying watchful. Oil and yields are still the scoreboard, and Powell plus labor data can move everything fast. Get some rest, tighten your levels, and come back Monday ready for headlines and ready for gaps. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.